You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 2/3/21. And, well, the markets are doing what the markets do. It looks like the Redditors have been beaten back for the time being, or perhaps it was never really a contest in the first place. I'd like to get your thoughts on it. Just send me an email to kl@kerrylutz.com. Right now, we've got our good friend, Eric Hadik, InsideTrackTrading.com. That's inside with two I's, INSIIDE, TrackTrading.com. Eric, it's great to have you back, and Happy New Year. We haven't talked to you since the holidays, but you more or less nailed the election based on the movement of the dollar.
Well, thanks for having me back, Kerry. It's good to be back. Happy New Year to you as well. And yes, the dollar is certainly one of those broader vehicles or broader measures that I've shown a linkage to some of the administrations of the past 40, 50 years.
And so I kind of was in a little bit of denial about what you said, but it kind of struck something, and I knew at that point that you were probably going to be correct. And for whatever reasons, we're not going to debate the election because our digital overlords don't want us to, and they'll wind up shadow banning this audio and video once it gets posted on YouTube. But it is an interesting pattern that the Democrats stand for free trade and everything else, and then we wind up with a strong dollar with them, and the Republicans, we wind up with a weak dollar. That is an interesting pattern. Yeah,
and I think that in different phases of that cycle over the last 40, 50 years, it has often been completely different motivating factors, and sometimes it's coincidence more than causality. But as I showed every time since the 80s, during Republican administrations, you had a decent sell-off in the dollar. Now, the first time in the 80s was a really sharp sell-off, and even back then, there was no hiding the fact. You could turn on a news channel any week, and either James Baker or I think it was Reagan, where they kind of swapped Treasury and Chief of Staff at one point, but they would be on the major networks talking down the dollar because it had such a depressing effect on exports and on trade. And so you've kind of seen that pattern flow through. There's also linkage to deficits, but it's, again, I don't even necessarily get lost in the weeds with what the policy decisions may be that impact that. I'm more an observer, and I see these patterns and try to understand them a little better, see if there is some direct correlation. And all my work said, back in 2016, I was talking about this, that I thought the dollar was about to top, and that was telling me to look for a Republican administration before we even knew who the candidate was. And now, for the last year and a half, what my work's been showing is that early 2021 should be a bottom in the dollar. We could still have one more sell-off before that bottom is intact, but I do think it'll be in the first half of 2021. And I expect that low to hold for at least a year or two, and that was hinting to me that you'd likely see a Democratic administration in office.
Mm-hmm. And so stronger dollar, all right, that's going to have repercussions, of course, probably on the deficit and other things, but nobody cares about deficits anymore. We're past the point of caring about them. price of gold, stock market, interest rates, oil, all these things are going to be affected. So let's look first. Stronger dollar speaks for itself. What effect is that going to have on interest rates?
Well, a lot of times that is which is the cart before the horse, or which, the chicken or the egg type of scenario, because, and this is what I warn about my readers with trying to apply too strict of a correlation. And what I mean by that is you could see over the next 6-8 months, the economy recovering, and a lot of the kind of commodity inflation that you've already seen, that could go into another phase, and you might start to see interest rates bump up, or at least a perception turn where interest rates is concerned, and that might be the thing that supports the dollar. Or you could have a scenario where other factors are impacting the dollar first, and the interest rate is just kind of going along with it. So the point is that a lot of times in analysis like this, I'm looking at specific markets independently, and I don't always know whether a correlating market will be leading or following the one that's in focus. I do think, regardless, that the interest rates set a multi-year bottom in the middle of 2020. That was a very consistent 4-year cycle that you've seen in the bond market and treasury notes that has just governed those markets for 30 years or more. And leading into this peak, you had seen very significant peaks in June, July of 2012, June, July of 2016, and that 4-year cycle was coming back into play in June, July of 2020, looking for a more significant peak, which is inverse of the interest rates. And sure enough, that's when bonds and notes peaked. I think we're kind of in a elongated topping phase, but that on balance, you're going to see interest rates nudge up over the coming 6 to 12 months.
All right, that's a reasonable forecast. So oil, you were kind of calling a bottom on it a while back. Looks like it's bottomed, and now it's over $50 a barrel. Where is it going?
Well, my 6 to 12 month outlook is still, since April, May of last year, is still that we would eventually make it up to $60 to $65 a barrel. And I am looking at the April-May time frame as a very significant cycle peak for me. So the two, there's a good chance that the two will go hand in hand, that would be when crude is getting up to that $65 level and potentially peaking. If crude were to reach that level ahead of that time frame, then more likely than not, I'd be looking at any additional upside targets. But right now, they're kind of the two primary things I've been focused on for the last half of last year and the first half of this year, and that's the upside target of 60 to 65 and the cycle high of April or May of 2021.
You know, it was interesting this year, Eric. We always hear on the news, summer driving season, oil prices, gasoline prices going up. You know, with COVID this year, they never really went up. Really kind of weird. It was the first year in my short existence on the planet where I didn't see gas prices go higher in the summer.
Yeah, and that's, you know, when you have such a big overriding factor like that, it certainly distorts different things in the markets. And so you've had unleaded gas continuing to rise through wintertime, which is, you know, often it's just the heating oil that's heading higher there. But it's in recovery mode. So that kind of factor this time around, I think, overrode any normal annual seasonal factors. And it certainly could start to start to get back in sync middle of this year. As you know, the pendulum could swing a little far to one side, whereas as more and more countries hopefully get COVID under control and you see economies opening back up, you'll see the expectations where things like crude are concerned probably swing the pendulum a little too rosy of a forecast or an outlook. But then you start to get back into sync, and by next year, you'll probably see, and any middle of this year, see some of those same seasonal tendencies back in play.
Yeah, it's fascinating to watch this whole thing unfold. I think psychologically, COVID, the pandemic, has been far more damaging, both on a individual basis, on a global basis, than the actual fallout from the illness itself. And that's not to underplay it or minimize it. It has been tragic. I've seen it myself, suffered from it myself. But the fact is that the vast majority of people who get it do recover. I'm one of them. And steps to mitigate it really haven't been emphasized enough. But point is that the damage to the psychology, I remember there was a guy, Howard Katz, and he had a newsletter called The One-Armed Economist, based on something that FDR once said. And he said economic depression actually starts in individuals' minds, and it stays there until they get out of their depression. And we see so much of that happening now. Stock markets. What can we look forward to even higher and detached from reality prices in the markets?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million-ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well-positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
You know, that is the $64,000 question. From a broad perspective, my outlook is still that we're in a bullish cycle from, you had a very significant cycle low in late March of last year. I remember talking about with you prior to that everything from a 40-year cycle and a very consistent 2-year cycle and a lot of indicators that I use to hone those cycle outlooks. We're calling for a major bottom in late March, and that next up cycle was expected and is still expected to stretch into about May of this year. Some indexes I could easily see going into June. And so I think you're still going to get another phase of bullishness taking over the market. But right now, I think we're in a little bit of a phase that may be comparative to September and October of last year, where you traded a little bit more volatile, but in a sideways trading range before the ensuing rally took hold. And that's kind of what I've been looking for in mid-January to maybe late February. See a couple of moderate sell-offs with equally strong rebounds in between. So you just kind of get this trading range that's more of a horizontal trend on the chart. And I think that once we get to March, that's probably when the next upturn you'll really see take hold and last into May or June. And that could be kind of like we're just talking with the energy markets, could be when you start to get that more bullish perspective and optimism throughout the world, not just in individual countries, not just in the U.S. or others, but getting that idea that things are going to be back on track and there's going to be this just overwhelming recovery, which never does materialize to the expectations that are usually there, but you'll probably get a decent surge there in leading into and through much of the second quarter.
And we're starting from such a low level that even if it's not a massive recovery in terms of numbers, it could look like one, even if it gets us almost back to where we were before the pandemic. Yeah,
and the thing that traders need to remember is that stocks and the stock market usually anticipate things 3 to 6 months in advance. So, a lot of the up move you've seen, particularly since the early November low, this 2.5 month rally, is looking out into first quarter, maybe even second quarter. And if we do see an additional surge there into May or maybe June, that would be reflecting not only what might be current at that time, but looking out 3 to 6 months. And so then the question becomes, once you get into third quarter, are there other things that maybe start to throw a little fly in the ointment or start to change that perspective? We'll get a better idea of that as that time nears. But just comparing the economic recovery to what the stock market's showing, there's always a time lag or a time lead there as well.
Yeah, of course. All right, so on to gold and silver, particularly gold. What are you seeing? What's in the crystal ball?
Well, starting from the broad perspective, nothing has changed for me since late 2015, early 2016, that all my long-term cycles told me to look for gold, silver, gold stocks to move progressively higher into late 2020, early 2021. And the major cycles that I was looking at were telling me that second quarter of 2021 could see a similar high in gold as in the stock market. And you see that sometimes in inflationary markets where right now things that are inflationary are viewed positively from the stock market's perspective. It means that they're expecting economic recovery and demand growing. And so the two go hand in hand, but you often get a scenario where that type of correlation works for 95% of the time, and then the final 5% of the cycle is when there's a disconnect. And so one possible scenario, which really the price action in the next maybe 3 to 5 weeks for me is going to give me a better indication if this scenario is likely, but is that you see another price inflation and gold and silver along with that up move into, say, May of this year. And you get to a point where stock market's going along with it, then all of a sudden those inflationary markets cross some arbitrary point, and all of a sudden it's like shifting or turning on a dime, that then all of a sudden the stock market starts to view it as being a negative or a risk factor. And so it'll be interesting to watch how if these markets do what I'm expecting and seeing another move up into May of this year, how that unfolds, and if it is enough of an inflationary move that you could see it start to impact the stock market. And if you look back historically, a lot of times you'll see these correlations. Sometimes it's inflation in stock market, sometimes it's bonds in stock market, where they move hand in hand for, like I said, 95% of a trend or a cycle, and then one of them suddenly does an about face, and And then within the final few weeks, you see a big move in an opposite direction to where 5 years later, when you look back on the charts and you say, oh, gold or inflation peaked here and the stock market bottomed at the same time, even though they had been heading the same direction most of that time, that there's a sharp enough correction at the very end that the two end up setting very significant turning points at the same time. And I don't know if I hope I'm not losing listeners there, but a perfect example was, now it's going way back, but in the 1980s with bonds and stock market. And often, depending on which one's leading, if stocks are really struggling, then bonds will often rebound on that, on expectations for lower interest rates to kind of help out the market and the economy. But you have these inflection points, these, just completely landmark times where when you saw in 85, 86, 87, interest rates had been ticking up, and stock market was going along with it because it was all looking good, that the economy was moving ahead at a good rate. And so bonds were actually ticking down that whole time from early 85 all the way into 87, or from early 86. And then you had that one couple week period in October of 87 where all of a sudden the stock market woke up one day and said, wait a minute, interest rates have been ticking up too much. And there were other factors as well. Stock market turned on a dime. Interest rates and bonds bottomed within days of when the stock market bottomed, even though they had been going at opposition for a year and a half. So you have these, like I said, these things where markets will run in lockstep with each other for a long period of time, and then at the very culmination of a trend, you just get this dramatic shift.
Yeah. Well, that's why there's cycles, and interesting that it could go that way yet again. Wouldn't be surprising for sure. Given us a lot to think over here, Eric, but your call on the election was pretty prescient for different reasons than everyone else's call. Had nothing to do with polling or surveys or anything else, just that dollar level. Pretty remarkable, I have to say. And we're going to be looking at it closely for quite some time to come. Hey, just tell us again the best place to find you and how we connect with you on the web.
Best place is at InsideTrackTrading.com. Like you mentioned, it's got that extra I in the middle, INSIIDE, TrackTrading.com. And you can see dozens of archived reports and articles to get a little taste of things that have been published in the past, but also contact us through that and or subscribe through that website. All the information that you need to learn more is right there.
All right, excellent. And any questions, comments, where you see the dollar going, where you see gold, just share your opinion with us. Send the email to kl@kerrylutz.com. Sign up for the newsletter. Got one going out tomorrow morning. FinancialSurvivalNetwork.com. Just click the button there, stick in your email address, and there you have it. Eric, always a pleasure, and we'll be following your projections closely, your forecasts. And again, best of luck for the coming year.
Thank you, Kerry, and thanks for having me back.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to FinancialSurvivalNetwork.com. Financial Survival Network, now more than ever.